Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now as we take a look at the market trade action on Monday as we get the holiday shortened week started. We are joined by our good friend John Heinberg with Total Farm Marketing. John, good to catch up with you, sir. And very interesting day. I think just to start off, crude oil. What was going on with crude oil on Monday's trade? I mean, we were down sharply and then back near unchanged, and that seemed to spill over at least in the soy complex, John.
Yeah, that crude oil market was definitely the wet blanket to start the overnight session into the trade today. You had just a Wall Street Journal article came out that Saudi Arabia was looking at a 500,000 barrel per day production cut. Production rise. My apologies. And that obviously sent this market tumbling, which is already dealing with a demand/supply issue. So markets broke to new lows, took out the lows from the fall, and then only to have a couple hours later have Saudi Arabia come basic out and say that story is not true. And they were not looking at that. If anything, I was a little surprised by the news myself because I've been reading rhetoric if prices got too low that they would be looking at a production cut to lift prices in that regard. So that's got prices rolling. Then late in the afternoon today, Russia came out too and made comments that basically if price curbs came in against crude oil, they would be looking at a production cut. So we've taken this thing full scale back from $4 to $5 down to near positive territory. Some of the deferred contracts have gotten positive. It's probably an opportunity in here in that crude oil market to look at some things. Again, we're pushing multi-month lows here, big reversals on the chart. Obviously the China COVID situation still weighs. It's probably the other thing that limited the crude oil market from really kicking in as negative news coming out of China regarding COVID. But at the same time, maybe this market's a little bit overdone here and it could be a good turning point. A lot of forecasts for crude oil prices to be a lot higher in the spring. Maybe that was that significant low we put in today.
Now, how did crude oil parlay itself into the soy complex on the day, John? I mean, bean oil was only up a little bit at the close. Meal was strong since the open, but yet we get beans 7-8 cents higher. So, I mean, what was the move there? Was it all crude oil? Was there other factors in soybeans too that kind of helped us to positive territory on Monday?
There's still a lot of factors going on in that soybean market outside of crude oil. Obviously, crude turning firmer helped firm up the other two parts of the system there. They got soybean meal finishing higher today. You got soybean oil, obviously tied to that crude oil and that biodiesel market finishing higher today. So that brought some money flow into the soybean market. Just the demand side of the equation, just good competition out there. We got weekly export inspections today. Still not where we need them, but the USDA ramped up last week's number by revising it higher, which was a pretty dismal number, coming in with a solid 2.3 million tons of bean shipments this week. Maybe some of that demand that we're worried about is still out there and these beans are moving. So that brings some buying strength in. Then we got to just go look at that domestic market, what's happening in terms of cash out there and bean basis. Again, in some areas as processors and end users are bidding for beans against the exporters at this time frame, gives us some support. Seasonality, typically we see decent strength in the grain markets going into the Thanksgiving Day holiday. Now, corn and wheat didn't want to play with that card today, basically due to, I just think, where global prices are and that stronger U.S. dollar.
Well, thinking about this grain complex as a whole, corn, wheat, we were down a little bit there today with beans, again, as we mentioned, higher. Now, we're getting into a holiday week where typically, I guess it could go one of both ways. It's either a quiet week with low volume or some of that maybe low volume leads to volatility. So as you take a look at the charts and kind of view the landscape here, what are your thoughts as we work towards the Thanksgiving holiday, John?
Realistically, the corn chart turned into a little bit of a buy signal last week with putting that little reversal in, seeing some of the technicals turn higher. Obviously, we're not getting a whole lot of follow through here, but we did put a fairly significant reversal in on the day of the Poland missile strike. And that just was kind of leading into this next couple of days. So markets have gone basically sideways from there. So we'll have to see. I still think the cash market and the demand by the domestic market is still going to be part of the lift in this core market here. As we've kind of got through harvest, we'll get those next round of crop harvest numbers today. Again, I expect it basically to be done. Obviously, there's still some out there, but again, those bushels that probably needed to get into the pipeline have moved. So therefore, the competition can pick up a little bit more on the demand side of things. So I'm still a little friendly corn. The biggest problem with corn right now, and then same thing with wheat, is where we are globally. You've got a major price push from other countries in terms of mainly South America, Brazil being number one in terms of corn. That's weighing on our price. If we're the most expensive corn in the world by far right now. And again, what's helping us is the domestic market versus the export market. Export inspections again today for corn were very disappointing. Again, we're going to probably still have a solid demand year, but it might take a while till we get the domestic market taken care of first before we can put bushels out there on the competitive scale on the global side of it. And that again just leaves me cautious of prices where we are here. If we got to come down to find some more demand, we will. And that's something that worries me for the spring and into the summer months, as long as the weather stays normal.
Well, John, I know there's a lot of different tools in the toolbox, so to speak, for farmers to protect themselves against the downside risk, leave the top side open, so to speak. I mean, we hear a lot sometimes about short-dated options. I know those are out there. I mean, as you look at this market, and you mentioned you're a little worried about price getting into, say, the spring. I mean, are there some different things like that producers should maybe look at? Obviously, again, with cash strong, that's another thing to take into consideration. It feels like there's a lot of tools out there, but it's also a very regional, very case-by-case, farm-by-farm basis right now.
It is very much so in terms of regional base. Again, we're still trying to smooth the pile out from the haves to the have-nots in terms of that domestic and that cash market. But, it's one thing I've talked about a lot of producers with. Let's get some puts underneath the bin out till July if you really want to store that product or have the need to store it. I know a lot of tax implications if you're shipping it out now and guys don't want to have extra money on the books for this year. That's something that does worry me too. How much grain is going to get held to the 1st of January and then come pouring out very quickly just to take advantage of the prices that are out there. Again, I like those July puts right now just because we've peaked this market 2 years in a row in May. That's when we get those combines moving in South America, whether it's corn or beans. And that's just going to put some direct pressure on our market. Just look at last year's fall off in terms of the May to the June lows, having those July puts to protect that bin. Again, it's about price flexibility here. You want to make sure you keep some type of flooring mechanism underneath, whether do a cash sale, buy a call option to keep the upside open, or do a put floor underneath this market, locking a good value and let your bushels be the upside run. It's still about that flexibility and making sure you take advantage of good prices. Because again, headlines come out, things change quickly, and those prices could disappear, especially if we get into the spring and the USDA continues to chop into the demand side. You start throwing another 100 million bushels or 200 million bushels of lost exports on this pile. All of a sudden, that tight supply picture looks a little bit fuller in a big hurry.
Wheat market down just a little bit at the close on Monday. I know we still have a lot of drought concerns. Central Southern Plains doesn't look like that's going to get any better anytime soon. We're watching a lot of rain in Australia. I know concerns about Argentina's wheat crop. And then, of course, who knows what we're going to get exported out of the Black Sea region. As you look at wheat, though, overall felt like an okay day on Monday. The dollar higher. Any thoughts in wheat right now as we head towards the holiday?
A lot of little headwind factors there prevented this market from going somewhere today. It's not like the fact that we got December back under 8, March in terms of Chicago wheat back under 820. That kind of felt like some pretty key support there, even though we did rally off those lows today, but we still finished negative. To me, it feels like the market's on a little bit of a slippery slope, at least in the short term, until we get something to trigger. Now, with that being said, still think maybe globally we're undervalued in terms of where wheat prices are. But we're not seeing that demand. That's some of the biggest keys here. Export sales numbers aren't there, and that's just going to, as we continue to struggle against the world's prices globally, U.S. dollar making a nice little recovery here. I don't think it's off to the races again, but it just feels like a recovery in a downtrending market. That just keeps some selling pressure into that wheat market overall. Now, again, there's a commodity, though. I do think there's more upside potential based on the headlines, and that might be a spot we want to make sure you got some call strategies over any sales. here. I mean, we saw what happened just with the Poland strike and the missiles here just a week or so ago, even though we gave that all back really quickly the next day. But again, that's just where this market is. There's just enough little brush fires out there between what's going on in the Ukraine, some of the weather concerns in certain regions, that if something does truly materialize and become something that affects the global supply, wheat prices are undervalued. The funds are pushing a pretty good sized short position. And if things did turn and they need to get out of that short position, that sets this market up for a pretty strong upside rally. But we need something to be the trigger to get that to go.
John Heinberg, Total Farm Marketing, is our guest here today on the show. John, we also got news on Monday that we got all the votes in now from the rail unions, and 4 of the 12 have voted to not ratify the rail contract. So I ask you your thoughts on how much worry you have here ahead of that. If they start to embargo certain hazardous materials and other shipments, I mean, how much could this play into the markets heading into the holiday and into the month of December, unless we get something changed there?
That's going to be a major concern. And maybe that was the other underlying factor weighing on the wheat and corn prices today. Again, beans are a different story in terms of we want to get those beans to the Gulf and get them shipped out in that regard. But, the rail is going to be very, very key for movement. And obviously that backs up the cash market, that backs up the supply chains. That can put pressure on cash overall. So that's going to be a big part of this that we do need to watch. Obviously, we're very concerned about what happens with these rail strikes. Hopefully we can get something avoided. This is a market that just needs to keep product moving and keep demand moving, and anything that can limit that and back up supplies, it's just going to weigh heavily on those grains here, at least keep the downward trend in place in terms of some of these things such as corn and wheat.
John, let's flip over to livestock. Let's talk through things there. Cattle market, pretty friendly cattle on feed report on Friday. And I know some of those placement numbers, especially, I think the lowest we've seen since the series began in 1996, if I remember right. Overall, cattle, not a bad day. And you mentioned to me, look out some of those deferred contracts. That seemed to be where a lot of the strength was. But as you take in that cattle on feed report and how the market performed on Monday, what's your reaction?
Kind of thought the way I thought it would go after I saw those numbers. I mean, you get placements down at that level, 2.5% or just a little bit under that, underneath expectations. Again, like you said, the lowest level since the numbers are being kept since 1996. And that's 2 consecutive months of a downside push in terms of placement numbers. That just shows us what's going on out there, that the cattle market is just missing cattle, period. It's a reflection of what's going on in the cow market in terms of cattle, beef cows. Again, slaughter continues to run strong, which was something we might start winding down here. That just tells you that the feed resources and the feed costs are weighing on these cattle prices overall and making these cows move. So with that just keeps this picture very, very friendly into 2023. As you saw today, good breakout open on some of those deferred contracts. I believe April on, new contract highs today. Still think we got a good chance to possibly go back to that 170 totals back from 2013-14. Just feels like we're there because the cattle numbers aren't there. The demand side of the equation is still holding together pretty well. Now, that being said, kind of watch the seasonality. Typically, retail values peak out here the first part of December for the year. We could see some walk back, but I think right now any walk back turns into a buying opportunity and to hold some length over cattle in the longer haul. If I'm a producer who jumped on some great prices, again, just like I'm talking about is price flexibility. I've been buying a lot of puts and just getting safety valve floors underneath the market, leaving the cattle open to the upside. But if you get a price that just sounds too good to be true and you got to lock them in, come back and make sure you're putting some call prices in here, because again, this market could get extremely volatile either direction in here. And again, with those numbers that we're seeing, we expect this trend to continue. It's not going to change on the next report. That these cattle numbers are going to tighten up, and 2023 is setting itself up to be a pretty friendly year in the cattle market because of that lack of supply, still giving strong, fairly good domestic demand.
How about that hog market? Looked like a little bit of spreading with that front month December against the rest of the complex on Monday's trade. I know we're about $4 higher in the cash index versus that December contract. What are your thoughts with the action that we're seeing in the hog market, John?
We've seen a really good move out in that February contract versus that December the last couple of days here. And, obviously that December contract is strictly looking at what's going on in the near-term fundamentals. Okay, retail carcasses, $93 on the close, $94 today at midday. That's a pretty low level. Not a lot of strength there for that cash market. And that cash market continues to struggle. You even got the index still trading a good premium to that December contract, but you go look at direct cash hog prices. They're kind of in line with December futures right now. So that just makes this December contract look pretty ugly at this moment. Maybe we get a little bit of turn after the holiday. We'll see. Typically, unlike beef cattle, pork prices bottom out around the Thanksgiving holiday, and we start seeing some firming up there. I think that's maybe what the market's anticipating because of the tighter supply. We're getting that push out into the February and longer positions. But again, don't fall asleep on things. There's good numbers out there. You're looking at 106, 107 out into June, July, and August. That's some pretty good floor. Obviously, too, we got to watch what's going on in the disease front. There's some chatter again that PRRS is starting to rear its ugly head, and that could affect those hog numbers, which are tight enough already. But there's going to be some spot in here, just like in the cattle market. You do one of two things. If you got the hogs, you take the price, you get a call over top, make sure you got some flexibility the upside, build some safety valve puts underneath this market if you want to hold the hogs and see. Think if you got a strong cash market to sell into. But again, just somehow protect the floor here. Keep that price flexibility in front of you. Those hog numbers are going to stay tight, and I think we'll continue to see that, especially when we get the next round of quarterly hogs and pigs and things of those numbers coming up here fairly soon.
How about that dairy market, John? I'm seeing a little bit of red on the screen there to start the week. What's going on?
Well, we saw a pretty big drop in cheese price, especially the barrel price, down another 8 cents today. We've just exploded that spread between blocks and barrels. It was pretty much step for step, and now we're pushing almost 40 cents difference between the two. Some of that's tied to holiday trade, retail demand starting to slow down now. The only plus is we got really good export demand, and that's going to maybe keep things supported, so we'll have to watch. But when we get those block barrel spreads widening out like that, it makes the market cautious, because the question in the mind is, does blocks come down to meet the barrel price, or do barrels come back up and meet the block price? And that usually, that block price can kind of dictate the way prices are trending. So we're seeing some caution, we're seeing some profit taking. It looks like we got a bit of a toppy market here, at least in the short term. If I was a dairy producer, I want to make sure I'm somehow protecting things a little bit here, especially getting out into next year. You got $20 on the board, at least in the midsummer. Make sure you got something working in this regard, because again, it's a market that could see some things change very, very quickly. And dairy markets don't have a lot of liquidity, and prices can move very, very fast.
Well, John, before we let you go, I'd have to think, not getting complacent here with the holiday week ahead. I know folks could be busy, family time, traveling, et cetera, but making sure they have that plan in place with their trusted advisor and just watching, because obviously even with a holiday shortened week, we could have that volatility out there with so many different things factoring around. So what would you say to that? Your final thoughts as we kind of wrap things up today?
Yeah, don't fall asleep on what's going on. I know it's, like I said, holiday week, busy family plans on top of what you're trying to get done in the operation. Don't forget, we do trade on Friday. It's a very shortened trading session. Basically, I believe closes around 12:30 that day. So kind of a sprint session, I always call those. Those can bring a lot of different moving pieces into the market because the players just aren't there. We'll see that trade even thin out more as we get in closer to the holiday. So a lot of things can really get happening in here. Again, don't forget to take advantage of opportunities when it's there. Make sure you, like you said, reach out, have the conversations, keep the plan in place, stay disciplined in your plan as we go forward.
Well, John, if folks would like to reach out to you, maybe make you their trusted advisor there at Total Farm Marketing, what's going to be the best way to get a hold of you?
Sure, I love chatting with them anytime. Give me a call, 800-334-9779. Shoot me an email, jonh@totalfarmmarketing.com. And again, don't forget our website, totalfarmmarketing.com. So again, a lot of things moving out there. Doesn't hurt to have a conversation, just see what other types of tools are available to you in the marketing window.
TotalFarmMarketing.com is where you can find more information. With that, John Heinberg, appreciate the time, sir. Enjoy your Thanksgiving holiday, and we will talk to you again next week.
Sounds good. Have a great Thanksgiving. Talk to you next week.
And that's going to do it for today's Market Talk. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.